thank you so much for joining us on stage. And I really want us to have quite a powerful conversation that does set the tone in understanding the direction of institutional investment. Following the presentations that we had from the initial panel, which gave us a review of the last decade, and even the presentation from Ronald, it's quite clear to say that there's been quite a bit of activity when it comes to the flows of institutional investment into the African continent. But given that we're trying to understand the landscape at the moment, we need to naturally get your views as panelists as to where this capital is coming from. Are we in a moment where we're seeing a change in the dynamism, moving away from FDI reliance to more local capital being invested across the continent? And if so, how is this change likely to be implemented, perhaps over the short to medium term? Let's start with yourself.
Sure, thank you very much. First of all, I think the perspective, and I did notice through the earlier sessions that there's a bit of focus on sub-Saharan Africa, and my perspective is coming more from the north.
But you might have noticed that given the previous panelists and conversations, RMB has you as one of the top performing economies on the continent. You also were one of the top FDI markets in the previous presentation. So clearly there's something magical in Morocco.
There is some stuff happening there. I think it's a bit disconnected with what's happening across the continent. Maybe just to give a little bit of background on myself, and I mean, I've been in the real estate market in Morocco for the past 10 years, and we've raised and managed funds for close to 600 million, or invested close to $1 billion for institutional investors, both locally and internationally. I think one of the advantages that we had in that market is that we've been able to work with the DFIs early on. We've been able to work with local institutional or homegrown money, as well as foreign institutions. So, and we've seen a little bit the changes in requirements. We've seen a little bit the trends that we've gone through in terms of what it was 10 years ago and where we are today. And so I think there's going to be more points coming on in the discussion, but at a high level, I think through, I'd say, the past 10 years is that we've seen a good amount of local liquidity that has invested in the market and that has given, I'd say, comfort to FDIs and comfort as well to DFIs in entering those, I would say, early on or greenfield investments in real estate. And that's been one of the key things that I've noticed. We've seen, and a lot of the players talked about it earlier, we've seen the yield compression a bit more maybe than other markets. We've seen a significant drop of cost of debt. And we can talk a little bit more about the fundamentals of how and why that cost of debt dropped over the past 10 years, because some of the fundamentals are regulatory. And we've seen how government actually intervened with the right instruments and the right regulations in place to encourage certain alternatives to traditional funding that we know in real estate, generally in the markets. And so, and I'll leave it for the rest of the discussion, but I think these are the trends maybe, and we can tag along some of these topics throughout the talk.
You're quite right. Certainly understanding what the outcomes of investors are, and of course the change in regulations, which plays a significant role, are themes that we'll certainly pick up on. But Nesi, I also want to come to you to get your views with regard to this particular matter, and of course how the dynamics might have changed. Are we seeing a change, especially given your representation from the private sector?
Yeah, thanks, Gugu. I think if you look at allocation of capital across the African continent and specifically into funds, it's happened at two levels. So the first would be at a fund level, where we, Stanlib as a business, would participate and invest in these companies, and then also at an asset management level, where we involved in various REIT companies across the continent. Especially at a fund level, what these funds are looking at are attractive internal rates of return. So being able to go into a particular country, buy an asset at an attractive yield and manage that property. We as shareholders in those funds are supportive where the yields are attractive, where the rental market is quite defined. With the cognizance that across various markets there's different types of risks, and specifically I think a lot of participants have made the comment that you can't actually look at the African continent in terms of just one country. It's a basket of 50 plus countries where there's different demand drivers, whether it's commodities or it's GDP deficits or it's currency volatility. We as investors have to price that. Liquidity has been a lot more important in terms of our investment decision of deploying capital into some of these funds. But what you've seen is very different strategies. I mean, if we sat 7 years ago, there were very little SA funds that were going purely into Africa in terms of direct investments. Most of them were doing it in terms of joint ventures.
Yes.
And those joint ventures were across retail offices, very little residential and industrial. And companies like Resilient, which had a JV with ShopRite to do development in Nigeria, they scaled back some of that. You had companies like Hyprop, which went into Nigeria and Ghana. We've been invested in some of those funds, but they've had to take write down on some of those assets. So the experience has been very different. You've had some success stories like Grit Real Estate, which have actually stayed the course, diversified their businesses across multiple jurisdictions in Africa, and been able to do very well. But you've also had those companies that have suffered write-downs and are now looking to recycle assets. So that's at a fund level. At an asset management level, what's very important, I think, for further investment into Africa is formalization of the regulatory environment in terms of the structure, which is typically what you've seen in the South African market has been a REIT structure, which is globally understood in most developed markets. It makes comparison of yields easier between investors in various locations. But it also gives a sense of, and I think the buzzword we've heard is sustainability, where you have a legislated regime where investors can price sustainable dividends, they can price the yields. I think there's a lot more comfort there as well.
We'll come back to some of the success stories that you can also share in managing to identify some of those sweet spots. But let's come to you as well, Kura, just to get your views with regard to this change in the dynamism of capital and exactly where it's coming from, and if we are seeing the comforts that have been mentioned by your colleagues appearing in the market to see further deployment.
Sure. Firstly, I come from a very little village called Harare. I see from the slides that were put up, you are very much against Zimbabwe and Zimbabweans. So
far from it.
As Africans, I'll say, you keep your Africa, we'll keep my Zimbabwe. I think we've been left off the map in the conversation precisely because of the Zimbabwe risk that has been seen in the market. When we had our coup, not coup, and military-assisted transition, the conversation that I was having representing a national pension fund was DFIs were coming in and saying, you're the local, what are you doing and what can we support you in? The areas of interests were they were never going to come and build a 20,000 square meter shopping center, but they said, okay, once we've got the income moving up, what follows? Then retail follows that. If retail is following that, how are logistics getting in and out? What are the logistics parks that are following? So we were trying to lead a future Zimbabwe strategy and then partnering with international capital that would come in with that. So partnership was what was key to us. I think if you look across the region, very few people have the kind of operating model to jump on a plane, get into a city and want to invest directly with real estate. They want to partner with somebody who's got some track record, who's got a particular nous in that area, and then they will put some capital in an appropriate structure to realize that local initiative.
Kura, you've got us excited because I think for many of us who've been monitoring the events across the continent, we just recently saw yesterday in the State of the Nation address by the President of Zimbabwe, President Mnangagwa literally said that the economy is dead in Zimbabwe. So that obviously speaks to new regulatory changes that need to be implemented to make sure that this institutional capital can probably be used as an igniter and to kickstart the economy again. What kind of conversations are taking place within the real estate environment and of course with regard to regulation for institutional capital to be deployed in this manner? And I'd like to throw it as well to the panel to actually get some insight as to some sweet spots that have worked in Morocco or other elements that influence how capital gets deployed.
Sure, as the moderator, thanks for teeing that up perfectly. I can say the economy is not dead.
Fantastic.
Look, Zimbabwe is finding its way and who it needs to be. I think if you look at the business that I represent, I've got one of my directors in the audience, so I have to be PC. We grow, sell, and market tobacco internationally. So in the logistics space, I have a 30,000 square meter pipeline of tobacco warehousing that can be done. And for us, that's the sweet spot. The Zimbabwean burley tobacco leaf has a particular flavor and it has world demand, so we are competitive on that. In terms of other elements, we're seeing in our little micro market, CBDs being under pressure, but some retail and hospitality areas having some highlights, Victoria Falls being one. There's direct capital that's being applied. We've got a bit of hospitality growth going on there. The student sector is something that we are looking to expand with international partners. We're saying, look, this is a human rights issue. Let's get universities at a certain standard, with a certain standard of education and support.
Sure.
Our tertiary sector, quite weak because we're not yet there. But dead, I don't believe we're dead. We have practical challenges.
I want to challenge you on that one even further, because you talk about significant opportunities that exist in that market. But of course, as investors, we want a return, Kura.
Sure.
How then do we navigate that landscape in making sure that we try to attract the capital despite the currency concerns, ongoing regulation and legislation changes as well, and the perception of this bleak economy?
So here we need to sit down and think hard. Look, our currency issue is the biggest issue. I'm sitting on my phone and I'm getting rental reviews from tenants going up 400%. This is in 3 months. Our currency, we have, how do you present financials when in 12 months you've had 3 functional currencies where you've gone from 1-to-1 with the Zim dollar to 32 to the Zim dollar back to 15 to the dollar? If there are any valuers and magicians, if you want to do an MBA thesis, you can come and value my portfolio and how you do that. The play in Zimbabwe has to be long-term. I think the interest when we had the kind of Mall of Zimbabwe as a buzz, when we had South African retailers wanting to expand in Zim, they always said, look, you've got to give us a spot in Borrowdale, in Bulawayo, in Gweru, in the center of the country. We've got the road infrastructure being improved. We've got the transnational highways coming in. So the return is not going to be right now. But within the chaos of the currency, therein lies the golden opportunity for anybody with hard currency to come and do a deal with me. I'll give you a good rate to your dollars, but take a stake. The current pricing in Zimbabwe right now, I'd argue, is option pricing. But we have assets that we can create, like in my business, a tobacco warehouse attracting $3.5 a square meter for an international supply chain business is going to be there for the next 20 years until everybody decides to stop smoking, and they haven't done so for the past 100 years.
I mean, just listening to
Jump in there.
Kura Guga, I think, I mean, one understands the sort of the difficulty with trying to price, I mean, just normal property assets in various jurisdictions and things like repatriation of income and dividends out of Zim. I mean, the difficulty that if investors have experienced historically, not just with property, but other commodity type companies. But also, I think once you're in those countries, the ability to get data, I mean, things like cap rates on offices and residential, and especially retail, I mean, it's not as easy as you would in maybe some of the other African countries. And also as well, I think if you look at liquidity, that when times are good and property prices are rising, the economy is doing well, liquidity isn't a problem. But when there is a crunch, and I think he eloquently explained it, that's when you get the drag in terms of return. Yeah.
So as a representative of institutional capital, what would need to change in Zim for you to put your money in there? In other words, I'm trying to learn from lessons that we can implement in some markets and previous successes to actually share with the audience regarding challenging markets across the continent, not just Zimbabwe, which is for all of us, by the way.
But Zimbabwe first. Zimbabwe first.
I think it's an interesting one. I think, and rather not just make it generic to Zimbabwe, I think across all countries, I mean, stability of currency is very important. When you make that initial investment and you're seeking an exciting yield, a lot of times that yield can be eroded away by devaluation of the currency. So stability, I think, from a central bank perspective, is very clear. I think there needs to be a path to growth, so a plan in terms of how the economy can get back to a stabilized level of real growth. And you see it not just in Ghana or Kenya or even South Africa, where economies have now gone to under 1% real, and all of the central banks and finance ministries are looking at a growth plan where they can revive either competitiveness in certain sectors, and property being one of them, but also trying to revive parts of mining, parts of industrial as well, to sort of get that incremental 2 or 3% real GDP growth. So we can then go and compete with the Poland that's growing at 5%, or a Romania that's growing at 4.5, where the yields are 8 and 9, and distribution growth is stable or sustainable, and where capital is tending to be migrating instead of staying here in Africa.
Yeah. Noel, I'd like to get your thoughts here, because this is obviously where some of the successes from Morocco do come in. The changes in regulation, the reduction in the cost of debt, which is quite significant, and that does speak to, again, additional sweet spots or success stories that we can learn from to gauge exactly what's happening in the North African environment regarding institutional investing. But what's worked there, especially the cost of debt reduction element?
Well, I think maybe it's I'll give a brief and come back to the cost of debt because it's related to other factors. I think the first one was to try to listen to the investors that we're trying to attract and ask them the real questions on why they are not there or why they're there. And I think about 10 years ago, a bunch of roadshows, and we're continuing our roadshows. I'm constantly on roadshows. And the feedback from foreign institutional money is simply two things: size and liquidity. Give us size and liquidity, and we will come in. And where does size and liquidity come from? One, I think Thomas earlier and Kevin, they were talking about it, is for them having exposure to single assets or single cities or small platforms is too risky. The small size means the governance that they're used to seeing in Europe or in the US are not, the mechanism of governance are not in place. And if you want to put them in place, then your cost of management becomes out of whack and your equation becomes out of whack. Just to give you some figures on REITs, for example, the average size of a REIT in France is $1.5 billion. The average size of a REIT in the US is $5.5 billion. That's the average size. And so when we're talking to these players who are used to investing in commercial real estate and used to investing in Europe or in the US, they're used to a set of fundamentals with REITs that come together with that size that we are not yet having in place for them. The second one, I think, which is a little bit contradictory in our speech sometimes, we talk a lot about long-term, and everybody's saying we want to be long-term or we need players that are long-term. When you go to the US or Europe and you speak to them, nobody's long-term. Disruptions are happening in their businesses. Cycles are not understood. Everybody wants to be short-term. Everybody wants to invest with the view that in 2-3 years' time, they can be able to pull out their money because they don't know if they're going to be in crisis or not in 2 or 3 years' time. And so the trick, when you listen to that, is to say, well, how do I make my investment, which is on the asset side, necessarily a long-term investment, but on the paper side, needs to be a short-term investment and the ability to give them short-term. Well, then I link it back to regulation back in 2009 or 2008, when the government sat down in Morocco and said, well, how do we bridge this? Because we're not able to get these guys in. Well, the only way to bridge it was first to say, homegrown money needs to come into the market and needs to ensure that there's a base of liquidity and a base of exit that's available for investors if they want to come in. Relaxing regulation for insurance companies in terms of using technical reserves for real estate. That's key because a lot of money is locked up and going into government securities and bonds, and that could be actually relaxed and directed towards real estate investment, and that needs to happen. Debt. Driving the cost of debt down means that you do not allow your banks to be the single lenders in the place, and so you need to actually introduce a buoyant or some active corporate bond market, or introducing the legislation for securitization so that actual commercial real estate can be, or cash flows from commercial real estate can be securitized. Sure. And when that happened, for example, I can give you the cost of debt about 10 years ago was somewhere around 7%. In terms of midterm debt for commercial real estate. Today, it averages around 4%. We went out last year with a bond backed by a couple of malls that we own, and our aim was to try the institutional market in Morocco in terms of their ability to take up on a bond. And so we decided to go out with a 60 million euro bond. We did probably about 35 meetings with all of the institutional investors in country, all insurance companies and pension funds. And to our surprise, the feedback was, well, the reason we have not been investing is we have not seen platforms And we've seen deals, and in the way we think, we actually do not manage very well in going into deals. So we want to see platforms. The bond was oversubscribed 15 times.
Sure.
Gives you an idea. I mean, there is money that could be redirected, but there are two drivers to that, if I may, and that's key and important.
Sure.
Stagnant or not very buoyant stock markets. This is a new trend. We need to take advantage of that. I think that's happening in many other places because a lot of these pension funds and insurance companies that are putting or betting on the stock market, the bet is off. And low interest rate environments all over in the world. And so if we can actually, just to get to that governance, size, and liquidity to fix for these institutional investors, they'll be happy to jump into the real estate sections.
Makes sense. I do want to follow up on this very briefly, but to the audience, due to the fact that we are under pressure for time, we're happy to take 2 questions, but to make it easy for us to identify you, please do raise your hand. My colleagues do have roving mics available to direct the microphones to you to address any of your questions. I'd like to build up on that theme that you mentioned regarding the domestic capital as well as pension funds, and perhaps throw it to the both of you as you continue to add your thoughts to this particular theme. For the last 4 years that I've been attending the API Summit, it's been a critical issue to unlock capital from pension funds. Kura, you probably can speak more on that particular part, but Nessie, share your views, especially when it comes to the dynamics of balancing social interests, where perhaps pension funds can participate in more affordable housing opportunities. Does that also allow for, again, additional camaraderie or new opportunities to be explored by alternative institutions?
I think if you look at it in terms of sort of pension fund legislation, I mean, most African countries have very established pension fund legislation. Particularly in South Africa, I mean, we're regulated by a piece of legislation called Reg 28, which allows for permissible investments into various asset classes. And historically, there's been a bias towards your traditional classes like equities and bonds and cash. What you've seen over the last 10 years is unlisted investments now start to pop up in those permissible asset classes. So unlisted property, listed property, and also alternatives as well. So things like affordable housing, infrastructure would fall into that alternative investment category. That's about 15%. Infrastructure would probably be 5%. And I think if you look across the African continent, I mean, affordable housing, clearly a shortage in most markets. I mean, South Africa, there's a shortage of probably 2.5 million deficit. If you go to Kenya, there's maybe a shortage of 1.7 million. The government there wants to add another 200,000. I think pension funds across the board particularly have the ability to leverage off this and play a big part. And certainly you look at markets like Nigeria where potentially the backlog in terms of affordable housing is 20 million plus houses of almost 400 billion. So it's quite large. I think there is scope within the pension fund legislation to increase the weightings of those and allow sort of deeper penetration into some of those markets. There have been some successes. I think in the listed fund space, you've seen some companies try and launch residential type funds to fill the gap. Sure. But it's been very tiny. I mean, the amounts need to be in the billions and not the hundreds of millions to fill some of that shortage.
Kura, you'd like to add?
Sure. What does a pension fund need to do? A pension fund needs to protect, grow, and cash flow. The constraints that we face in Zim is that we're strongly regulated, where the regulator puts out a model portfolio, despite whatever exposures might be different. The Gugulethu pension fund for Gugulethu Pty Limited might be different from mine, our age profiles and all the rest of it. So we've got this tick box exercise that we all have to fit to. We are a greenhouse of capital. We're not allowed to invest outside of Zimbabwe's borders, so that makes the asset allocation internally rather inefficient. And then we're not helping the pension fund by having an exposure to the very tricky situation that we have. So when I was earning US dollars in Zimbabwe in 2016, I was putting it into a pension fund. What can I claim now? Can I claim 72 RTGS dollars to what I put in? So I'm locked into the very issue that I was trying to diversify away from. So what pension funds can do is motivate for some sort of asset swap capacity, that we can bring our money to South Africa or Gaborone and earn a hard currency that when we remit. We've got a perverse situation where our National Railways of Zimbabwe pension fund is hugely invested in London real estate. So some guys who work in NRZ Zimbabwe retire and claim pension because the payout on their pension out of the UK property fund is greater than the cash flow they get in the country. We need to reverse that. If you can responsibly put money into institutions, and the institution I used to work for, we invested in a building society. We came up with a dynamic credit scoring model where open an account with us, make your deposits. If you're selling tomatoes or peanuts on the side of the road, we just want to see a cash flow. We will count about 70% of that as your earnings. So it's not necessarily payslip generated in a country that has 90% unemployment, but you've got a cash flow, and you have now unlocked a supply chain that we can sell service stands to, that we can sell cement to, and we have a multiplier that a pension fund is unlocking the value add of creating further real estate assets. And that was the entry into the affordable market space we did.
Makes sense. I do want to cross to the floor just one more time to double check if there are any questions. Any questions? Okay, we're shy, but we'll allow you to interact during lunch as well as the tea break in just a moment. I do have to wrap this up given the pressures of time, and in the first panel, there were a number of themes that were thrown out regarding sustainability, revision of expectations regarding returns, and of course understanding the growth opportunities that need to be considered, and consolidation, which will be big themes within the property sector moving into the next few years. I want to throw that back at you to actually give us your themes and your words that you'd like to describe the kind of interaction that needs to take place between institutional investors as well as members of the property space to make sure that in the next 10 years, we're having a completely different conversation that actually leads us to a positive direction where increased capital, domestic capital is deployed, and we're seeing further investment in the property sector, which then propels further economic growth, as was seen in Ronald's presentation. I understand your first thought. You obviously shared size as scale as well as liquidity were your two themes, but if we had to take it further, what themes need to change?
I think for us real estate managers is not to completely disconnect our thinking from general capital markets, and not to forget a change in global environment in terms of not only governance, but also in terms of ethics and moral investment and ESG rules, and a number of changes that are happening globally, and people are waiting for us to be implementing them as well on the continent if they want to attract that capital.
Fantastic. Let's get your thoughts.
Thanks, Gugu. I think sustainability is of income probably top of mind. Investors can price that and put a high degree of confidence in terms of the income they're getting out. I think regulatory environment needs to improve across most countries, and specifically as you see some of those economies moving to a more formalized REIT structure, and I think just maybe stability of economies as well. I think the political environments has been choppy, to say the least, across some of them. And if you're a foreign investor sitting in a developed market, I think if you see a period of stability, it gives you some comfort that you can deploy capital.
Fantastic. Kura?
Given that South Africa, even with its relative size, is 0.5% of global GDP, so a little place like Zimbabwe is point something, something, something. So when you've got choices, make sure you're the best in class. So specialization is going to be a key. Get to areas, do we need another 20,000 square meter shopping center that has South African tenants relying on the same cash flows that the country is? I don't think we're moving forward, but if you specialize and you put your money in a tobacco warehouse that's exporting to China, hallelujah, we're winning.
We see where your money is going quite clearly.
Sure, but number two is information. I always marvel at the MCSI index or anything that gets put out in South Africa, the transparency of it. Vantage Properties in Botswana puts out research. You've got data that you can put. I'm tired of going to investment committee meetings with anecdotes. You know, I'd love to have a data set that I can put forward. So as an industry, we need to share that information and put it out there. And then thirdly, we've got to leave the old-headed Madara behind and say, guys, the assets that are appealing to people right now is a WeWork in I-Towers in Gaborone. It is a fractionally owned shopping center with smaller retailers who are selling headsets or battery recharges or something like that. So we've got to match the the staid regulatory kind of thinkers with actually what's on the ground to make sure that we've got an effective demand where people are understanding what needs to be done and are putting money where it can circulate, because that's what we need to get going.
Fantastic. Gentlemen, thank you so much for your time today, sharing issues and themes regarding regulation, sustainability, data, and of course making sure that we work on our regulatory environments as well across the continent. Clearly, it's not a Zimbabwe for Kura alone, it's a Zimbabwe for all of us, the same way that Morocco has presented opportunities for many players across the continent. So ladies and gentlemen, a big thank you as well to my panelists for sharing their views and insight with us. Thank you very much.